Welcome to the Skilled MBA Finance Case Study Series, your destination for practical insights into financial decision-making in dynamic market environments. Today, we examine the Southern California Industrial Freezer Drive Case Study, a compelling real estate private equity scenario shaped during the height of the COVID-19 pandemic. The case focuses on a strategic investment decision involving an industrial freezer facility in Orange County, California. Amid global uncertainty, the firm must evaluate market entry timing, risk-return trade-offs, and the alignment of the asset with its long-term strategic expansion goals. The pandemic-driven demand for cold storage, coupled with the region's industrial growth potential, presents both opportunity and complexity. Key decisions hinge on asset valuation, lease stability, and macroeconomic forecasts, all critical for a sound investment thesis. A Boston-based real estate private equity firm evaluates its inaugural West Coast investment amid the COVID-19 pandemic. This industrial property in Orange County offers a strategic entry into a burgeoning market, presenting a unique opportunity despite global uncertainties. The decision underscores the firm's adaptability and foresight in navigating pandemic-era challenges. Freezer Drive offers cold storage capabilities, crucial in Orange County's high-demand submarket. Situated in a prime industrial corridor, it benefits from strong transport links and rising e-commerce needs. The property presents value-add potential through visual and functional enhancements, boosting both its market value and tenant satisfaction. Orange County's industrial market benefits from strategic proximity to ports, highways, and major metropolitan areas. The e-commerce surge fuels demand for last-mile distribution facilities. However, limited developable land poses a barrier to entry, enhancing the market's exclusivity and potential for rental rate appreciation. Historical data indicates robust potential for above-market rent growth in this submarket. Targeted renovations and upgrades can significantly boost property value and tenant appeal. Establishing a West Coast presence offers a first-mover advantage for a Boston-based firm, enhancing strategic market entry. The pandemic has introduced significant market volatility, complicating operations. Securing and retaining tenants is crucial amid economic uncertainty. Renovation projects face risks of budget overruns and timeline delays due to supply chain disruptions. These challenges require strategic planning and adaptability to navigate effectively. Cold storage facilities face unique challenges, including higher construction and maintenance costs due to complex mechanical systems. Specialized tenant requirements and energy efficiency are critical, especially with growing demand from food delivery and pharmaceuticals. These factors necessitate strategic planning to ensure operational success and market competitiveness. The strategic dilemma involves choosing between entering an untested market or preserving capital. Expanding to the West Coast offers a first-mover advantage and portfolio diversification, but requires higher risk tolerance. Alternatively, preserving capital reduces downside exposure, but risks missing market recovery and delays geographic expansion. Each option presents unique challenges and opportunities. Tenant default is the primary risk, significantly impacting financial stability. Market volatility, exacerbated by the pandemic, further complicates risk management. Evaluating tenant quality is crucial to mitigate these risks, ensuring a stable investment environment. Prioritizing credit-rated tenants with long-term leases can reduce exposure and enhance portfolio resilience. Tenant quality is crucial for investment risk and financing. Ideal tenants are credit-rated with long-term leases. Strong tenants are established regional companies with cold storage expertise. Acceptable tenants are growing companies with solid financials. Backup tenants have short-term leases but potential for conversion. Each category affects the risk profile and financing terms differently. Achieving a 15% target. Internal rate of return over a 5-year hold period is crucial. The projected capitalization rate at acquisition is 7.5%, indicating potential profitability. A capital expenditures budget of 20 million rupees is allocated for property improvements and upgrades, ensuring asset value enhancement and competitive positioning in the market. Market rent per square foot is expected to rise significantly, driven by economic recovery post-pandemic. Vacancy rates, which spiked in 2020, are projected to decrease as demand stabilizes. This analysis underscores the importance of strategic timing in market entry to capitalize on growth opportunities and optimize investment returns. Evaluating investment opportunities demands a nuanced risk-return balance, especially in uncertain times. Geographic diversification offers strategic advantages by spreading risk across markets. Lease structures, including tenant quality and terms, are crucial in shaping risk profiles. In industrial real estate, timing, location, and tenant factors are key in defining property value. Balancing conviction and caution is crucial when entering new markets. Firms must weigh the potential rewards against the risks of uncertain conditions. Strategic decision-making involves assessing market trends, financial stability, and long-term growth potential to determine whether to invest now or preserve capital for future opportunities. This case study highlights the delicate balance between conviction, timing, and risk in real estate private equity. It serves as a testament to strategic decision-making in uncertain markets. Thank you for watching this episode of the Skilled MBA Finance Case Study Series. We hope it helps you better understand how private equity firms assess strategic investments under uncertainty. Mobile +91-8 7553-00795 email support@skilledmba.com. Website www.skilledmba.com.